Good morning. Welcome to a What's Up with the Market session. We're going to do a market status update. It's the 1st of 2024. Welcome to 2024 and Happy New Year to you all. Let's hope it's a prosperous 2024 for everybody who is watching here today or watches the recording. Right, we are going to get right into it. But before we do that, let's cover this. We have to tell you that everything we cover today is general investment advice, and there's no specific or personal investment advice that we cover here. We will be looking at up-to-date prices, so please don't construe anything as direct investment advice that we cover here today. Right, straight into beyond charts, and we will start where we always do with the Dow Jones. Now this data is not updated yet. Don't have today's data of the US markets, but I have had a quick squiz at it elsewhere. And let's just talk a bit generally, and then I'll tell you a bit about what happened in the US session today. So I haven't moved this upper resistance zone, this black dotted zone over here, which marks the all-time high that was achieved way back here in the end of 2021, some 2 and a bit years ago. And the Dow Jones has not achieved that or got anywhere near it until we had this breakout just over here, top right hand corner. And what we are looking at now, and this is the key message that we are going to be looking at over the next few weeks, is I expect a retracement to come close to this resistance zone, which has now become a support zone. And that's where we have to keep an eye on, because that's what's going to tell us whether this breakout is going to continue or not. So, and that's pretty normal with markets. We have breakouts, or even stock prices, any price movement. You have a breakout to new all-time high. There's a little bit of indecision there. The bit of an arm wrestle goes on between buyers and sellers. And typically what would happen is you would see a retracement to come and test that previous support zone, the resistance zone, which now becomes a support zone. And that's what's going to happen over the next 2, 3, 4, 5 trading sessions as we get into the new year. Now, I do know that today's bar, it was an open, prices went higher in the indices and then fell away towards the end and ended up roughly where the previous day's close was. So what that's telling us is buyers got into control during the day, during the session, but sellers ended up in control towards the end, which is not positive. But having said that, on the Dow anyway, there's just that one red bar, just zoom in a bit, that you can see top right hand corner here, and the next bar is basically ended where the previous day's close was. So this is, I just want to note over here, just look at how far the Dow Jones is away from its trailing stop. It's in all-time new territory, and it's also above. It's quite a long way above its trailing stop, so there's some room over there. The other thing to look at is down the bottom over here, this blue line, slightly trending up, is telling us that the Dow Jones is outperforming the S&P 500. So the top 30 stocks outperforming the wider group of the S&P 500 stocks. Right, let's just go down into the S&P 500 now. And what we see here, I'll just go back left. That is the all-time high, top left. That is the resistance zone, the dotted black. And the S&P 500 has not broken through that yet. So I'm putting more credence on this being a broader market index. And we've had a retracement. Now, that retracement that we're looking at in top right-hand corner here is pretty normal. In fact, you would expect a retracement to be a bit deeper given the run-up that we had from all the way back 30th of October. That's a pretty steep run-up. Took out that previous high and broke right through it. Didn't even come back and test this resistance zone, which became a support zone. Went all the way up to test the all-time high and is now finding some resistance. Sellers in control, and that's pretty normal. And in fact, as I said, I'd expect this retracement to be a bit steeper, bit deeper, not necessarily steeper, but a bit deeper than what it is. So this is going to be telling time. It really is. Those of you who watched the secular bull market update I did in the week before Christmas emphasized this. As the secular bull market is still intact, but it does need the indices, the major indices in the United States, to break out to all-time highs. That's all three of them, and then to continue higher. And until that happens, if we just extend the range a bit and then fall back into the range, and there's a lot of indecision around these points, these are big inflection points in the markets, then that is not a strong sign. I know I spoke about the wall of worry. That wall of worry seems to have got a little bit bigger, more worry, more weight into the worry than what was even 2 weeks ago with war and all sorts of things being spoken about, and Israeli, what's happening in Israel and Palestine. So this wall of worry is getting a bit worse, if you like. So let's don't go on innuendo. Let's don't go on conjecture. It all comes back to the price action. The market is going to factor all of this, discount all of the positive and the negatives in there, and then it's going to be a net up or a net down. That's effectively what's going to happen. So don't get sucked into the news or the noise. Let's follow the price action. The market will do what it's going to do. So that's a little bit of a negative, but as I said, it's pretty normal for what we would expect given the run-up that we had from the end of October for a full 2 months. What the cumulative new high, new low here, there's a bit of a positive here that is rising, starting to rise. That is good. A bit of a tick down in the index. So the blue line is the S&P 500. The gray line is the new high, new low, and that is rising, a little bit flattened out in the last period. This is a cumulative advanced decline line of the New York Stock Exchange index, which is about 250 stocks, and we don't have any divergence yet. There are two higher highs there, and we've got this rising, which is what it should be doing. So breadth of market is looking okay, not too bad. The number of stocks above their 150-day moving average, similar peaks to what have been achieved over here. The overbought zone is this red line up here, haven't been up there, and so this is doing what it's supposed to. Most of the stocks are above their 150-day moving average, around about 73% of them, and nothing more to report there except that breadth of market is pretty healthy. Right, looking at the US dollar, this, as you've heard me say in the past, this is the highest correlation that you have to equities. US dollar index, not the US dollar against any single currency, but against a basket of 6. And just look at how this correlation just continues to play out. I'll just zoom in here, and you can see the US dollar equity starting to fall a bit, US dollar starting to rise a bit. It's a very close negative correlation. But we do have, without going into too much detail, because I've got a relative strength line here, so this blue line is measuring the relative strength between the US dollar index and the blue line being the S&P 500. So effectively, when this blue line is falling, meaning stocks are outperforming or the US dollar is underperforming equities, that is a positive sign. So I've just got a smooth index, rate of change indicator here called the CRB, and it's quite a long-term one. So we're looking at big picture, a little bit of delay there. And this is showing, I've got a green line here showing that that's risk on. So even though we've got a few blips, the longer term, the medium to longer term trend is that equities are outperforming the US dollar index. But this is one we've got to watch pretty closely, particularly this relative strength line and what's happening with the correlation here. So that is positive at the moment for equities. Looking at the growth stocks versus, this is Russell growth versus Russell 1000 growth versus Russell 1000 value, a relative strength line again. And so this is the relative strength. This is the Russell growth, and it has been outperforming value for some time, but just dropped below the moving average here and a bit of weakness. So that's showing that value is starting to come to the fore a little bit. So that's a risk off sentiment indicator, if you like. So a bit more strength going into value versus growth there. And I've got another smoothed index rate of change indicator here, trend indicator on the relative strength line, and it's just starting to blip down over here. So if that falls below 90, we're going to have a situation like this, which would be one of the sentiment indicators saying that growth is underperforming value, which is a risk-off sentiment indicator, but that hasn't happened yet. Looking next at discretionary versus consumer staples, same thing here. Just looking, my eye goes, when I'm looking at this quickly, I go straight to this trend indicator here, which is an indicator of the relative strength and hasn't dipped yet. So this is still risk on. So a little bit of a dip just towards the end over here, but we don't react on short-term data. Is what that's showing is discretionary is starting to underperform staples, which is another cautionary sign from a sentiment perspective. So some early cautionary signs here. The next one is, I'll just go down and back up because there's a problem with my moving average here. There we are. There was risk on, and now we're starting to get into oversold zones over here for being risk on, which means that this is this indicator I'm looking at here is the put call ratio on the S&P 500. This can stay bottomed out here for quite some time. It doesn't mean just because it's got into this oversold zone, if you like, that it's going to suddenly turn up, but just a little bit of an uptick there is showing that the calls are still, more calls are being bought here than puts, but a little bit of an uptick. So just to go back in history, just to show you that this indicator can drop here and stay down for a long period of time. So there was equities rising, more calls being bought than puts, and the smooth index rate of change indicator stayed there below the oversold zone for quite some time while equities rose. So doesn't mean just because it's got down here that there's anything to be afraid of. And we still have more calls being bought than puts. So that is a risk on indication, short term. But that, having said short term, it is a little bit of the actual, let me go back and explain that. This squiggly gray line over here is pretty short term, but what I've got is a 250-day moving average smoothed on that, so we don't knee-jerk react to the puts and calls going up and down like this. So you can just see the gentle rise, gentle drop off over there, which means that there's looking at a medium to longer term perspective, we're looking at these indicators to take out this very bumpy put call ratio. The next one is yields, so 10-year Treasury yields. We have a downtrending line, a channel here, and a little bit of a blip above to show an increase in yields. And however, I've got this medium to longer term smooth index rate of change over here. So what this is showing, this blue line, this relative strength falling in this area over here, showing that equities are outperforming bonds or yields of bonds, and which is positive for equity markets. So a little bit of an uptick over there, and an uptick over there as well. So, but nothing, still short term. It's sentiment indicator using bonds versus stocks. Not as strong a correlation as what we have between the US dollar index and equities, but still one sentiment indicator to be taken into consideration: stocks versus bonds ratio. The VIX, the fear index, is still down at pretty low levels. So nothing indicating there that there's anything to be afraid of. Right, I've got the latest data. Looks like it may have come in. I'll just put a value line on there quickly. That is the 4th of January. So we do have that data. And what that is showing is a sell signal on the NASDAQ. So this is the NASDAQ Composite Index. And that has given a sell signal now. So a little bit of cautionary on stocks, on obviously the NASDAQ stocks, the broader index of tech stocks, if you like. We'll have a look at the NDX at the moment, the top 100. But just to put this into perspective relative to the Dow Jones. So this is the all-time high on the NASDAQ. Remember that the Dow was above its all-time high, above the dotted black resistance zone, which is now a support zone for the Dow Jones. The S&P 500 got to its all-time high and found resistance and has fallen back. The NASDAQ hasn't got to its all-time high yet and has got some weakness in it. This trailing stop over here has pulled up quite nicely and has given an early sell signal on the NASDAQ. So let's see that indicator is pretty good. It can whipsaw at times, but that is not a risk on index. That is not a risk on signal, if you like, coming from the NASDAQ. So the three indices are not in sync at the moment. The NASDAQ is definitely lagging. I've got this long-term, medium to long-term indicator here on the relative strength. This relative strength line is NASDAQ v S&P 500, and it's been going sideways but down. But this Ciroc is what I want to keep an eye on as well from a technical analysis, a subjective technical analysis perspective. Remember, this sell signal over here is an objective mechanical system exit signal. But so two clashing over there, and this is a good time to say, because I've had a number of customers write in and say, why do I do these sessions? Because we are mechanical active investors, mechanical traders, medium-term mechanical swing traders, if you like. And I just got to tell you that I don't take into account any of this analysis I'm doing now, which is generic technical analysis, into my decision-making for the portfolios that I run. I'm 100% mechanical, and I use the trailing stop, this average true range trailing stop line and breakout line, which is modified and has, I won't go into the details of how it works, right now, but I use that 100% for all my trading on individual stocks and on indices. So I don't give any credence to any of the generic technical analysis that I'm covering here at the moment. And on that, I'll just answer a question that Bruce has asked: is will there be a weekly wrap on Monday? Next Monday? No, there won't be. It's going to it'll be the following Monday, the 15th, when Dave is back on leave. So there won't be a weekly wrap this coming Monday. Right, on to the NDX, which is the NASDAQ100. And I've brought this into the analysis. I don't normally cover this. I normally just do the NASDAQ Composite. Why? Because why have I brought it in? Because the NASDAQ100 did break above its all-time high from back here at the end of 2021, just over 2 years ago. And this is where it's at the moment. So it's had a breakout. It has not given an exit signal like the NASDAQ Composite has on our mechanical system. It's just there you can see the bar. Buyers were in control early in the session, and the close was just slightly below the open. Sellers ended up in control, but just slightly above its trailing stop exit over here, which hasn't occurred yet, which has happened on the composite. But the interesting thing here is that the breakout above, and I covered this in December in the last session I did with what's up in the markets, but also covered it in the secular bull market update. You can watch that on YouTube. If you haven't watched it yet, just go to our YouTube channel and you can see that. And it has broken back down. So support hasn't held yet. Now, from a generic technical analysis, subjective technical analysis perspective, I typically want 5 bars to be below a support zone, previous resistance, now support zone, to give credence to that. Now, if the NASDAQ100 falls sharply from here, gives an exit signal, and the next 3 bars end up down here, then it's unlikely that the 5th bar is going to get above. So very, very important times that we're living in here from an equities perspective in the United States, and keep an eye on this. This really is going to play out in the next week or two as to whether we're going to have some more volatility and some more weakness and some stronger pullbacks, or whether the buyers are going to come in here and are going to follow through on these breakouts to new all-time highs on the NASDAQ100 and on the Dow Jones. So we need the broader market to come in here, and it hasn't yet come in. So questions still out there, still cautionary now. After this run-up we've had, if we do have breakouts, if these breakouts continue, so we see the NASDAQ100 and the Dow Jones continue higher, and we see the S&P500 break above that resistance zone, and we don't have shallow retracements, which these retracements that we're now are still pretty shallow, then it's going to be all on. It's going to be risk on, big, strong, and I'm sure that we will see the mid and small caps come into reckoning there as well. But that hasn't happened yet. So big run-ups that we've had from October. Some pullbacks are expected. This is normal. It's how deep those pullbacks and these retracements are is what's going to be telling going forward in the next short while. Right, the NASDAQ, cumulative new high, new low has ticked up. So a bit of strength there, breadth of market indicator on the NASDAQ. And this is the advanced decline line on the NASDAQ 100. So just the 100 stocks, you can see it's pretty sensitive, and that is going in unison with the index. This is breadth of market indicator. Number of stocks above their 150-day moving average dropped off quite sharply in the last couple of days, but still up there, still most stocks above their 150-day moving averages. And next is the SOX, which is the semiconductor industry group. Buyers did end up in control in the session, the last 2 sessions, even though the price fell a bit. Some broken below this trend line. I would expect. I've just drawn it touching these 2 points, but really I would expect this trend line to the way I'd look at this analysis is really in parallel to the previous trend lines that are there. And in fact, you could even put this dotted line over there and touch those points to see how it holds. So a number of ways. While these touch points are still forming, there is a little bit of discretion as to where these points should go. That's probably more like parallel over there. So this stage, the price is having a retracement. It hasn't made a lower low yet. So this sentiment indicator on strength, particularly in semiconductor stocks, is still holding its weight here. There is the risk on that occurred in the Ciroc of this relative strength. I'm comparing it to the NASDAQ Composite. So this is still a positive sentiment indicator at the moment. The All Ordinaries has broken above this resistance zone, but not its all-time high, which should be there. Just got to that resistance, needs to go a bit higher and break above that all-time So these, you can see the All Ords has touched this three times before. This is the fourth time. You'd want it to go through here the fourth time. Otherwise, that will be an indication of weakness. So another inflection point in the Australian market, strong run up, expecting a retracement. The shallower this retracement, the same with all the other indices, the stronger the indication of market. So we do need to, these retracements, they do need to be arrested and then to continue on from there. Australian dollar, a bit of weakness, but looking pretty normal. It hasn't made a lower low yet, and that is still in an uptrend, even though it's got a retracement. So looking all right there. Okay, just to have a look at a couple of the other international indices. This is the Nikkei, struggling to get through. This is not an all-time high, even though I've got the black dotted line here, because the last all-time high was back in 1989. So treating it just as an all-time high, giving it similar significance, and has battled to get through the zone. Buyers did end up in control in yesterday's session, fell away, and buyers ended up right at the high. Let's see what happens with the Nikkei and you wanted to break above the zone here for strength in that market. Then the DAX did have breakout above its all-time high. There it is back there in also end of 2021, and is now found in last night's session or yesterday's session on the DAX, found support there. Let's see if that follows through and gets above, makes a new all-time high. So a number of indices to look at here. Certainly not a time to panic. Right, let's move on to commodities. The CRB Index has broken out above this channel. It broke out above this quite strong resistance point. This is the 50%, without going into too much detail. It's a big, long trend over here. This is a semi-log chart, but that is the 50% mark of that big downtrend that went from all the way back in 2007 when it peaked and broken out above that channel. Got to the 50%, the Fibonacci retracement here, found some resistance, pretty normal, and that retracement also normal given that uptick over there. So commodities having a bit of a rest, and this is a weekly chart, so it's showing quite a lot of data, and it has broken out above this channel, this downtrending channel, needs to get above this resistance point and has found some support here. Let's see where it goes. But there is this long-term cycle on commodities, of which gold is not part of that CRB index. It has found resistance. There's its all-time high back in 2020, found resistance again, and resistance again, fallen away, struggling to get through that 2100 level. So my call on gold, people always ask me about gold, is gold going to go higher here? Gold will battle to go higher with any strength while we're in a secular bull market in equities. Gold will have its strength again and probably run to the 3,000s and the 4,000s and the 5,000s. That's dollars per ounce when we get into a secular bear market in equities, which will run for at least 10 years, 10, 12, 13 years. We're not there yet. And gold breaking out and getting very strong will be one of the signs that we're looking at to see the early signs to signify to us that maybe the secular bull market in equities is over. So I expect there to be continuing resistance here in gold and not to be a strong run up in gold until the equities, the secular bull market in equities ends. As I covered in the session just before Christmas, the secular bull market update is there are a number of high profile people that are saying we're already in a secular bear market, which is just really a guess because there's no data to confirm that. So it's beyond me why high profile people continue to try and predict to make a name for themselves. They already made a name for themselves. Right, silver is nothing to write home about there, pretty much following gold and a little bit weaker than gold. Copper, we do need copper to break out here for the CRB index to continue higher. Copper and oil are the two big players there. Has broken out of this downtrending channel here, resistance, which is pretty normal. And we would like to see copper to rise above this 400 level and then go higher. And that would bring the small to mid-cap stocks into play as well. Oil in a downtrend, hasn't broken out of this channel yet. This is a big, strong support zone between $70 and $75. Found that. This is Brent. This is not light sweet. And we can see oil is underperforming equities over here, just mainly through its own weakness. The Bitcoin is in this uptrending channel, had a big run up all the way, almost doubled, well, not quite double, went from around about 22, I think, 25 to all the way up to 45. So not quite double, but a big run up. now having a breather, which it should do. And we need to see whether it stays in this uptrending channel. If it does have another run up, it will be a strong run up. But certainly, this is the trade here using the SROC 26.9 is showing that this is still an open trade. If you had bought it all the way back here at around about $26,000, and Ethereum is not as strong, but certainly bobbing along over here below this channel. But crypto having a bit of a run at the moment. This is uranium. I'll just zoom out here because this is showing just to show the strength of the uranium price. It has broken above this 50 percentile, which is quite a strong support resistance area in a semi-log chart. That's a Fibonacci 50% really jumped out of above this resistance zone and going towards the all-time highs that we have from 2007. And how do you trade this? With the URA ETF. This is not a close tracking ETF of uranium, but at the moment the ETF with this rising here is showing that the URA is actually that the price is outperforming the ETF. So if you're in ETF, you're not going to see as much growth with this relative strength line here telling us that. So URA underperforming at the moment. There's a period of time where URA outperformed uranium. So the real way to play this uranium uranium stock price, is to do it with uranium stocks. URA is not a good reflection of it. Iron ore is broken out above this the 130, 125, 130 level, and these downtrending lines. Time for me to start putting an uptrend over here, but that price is getting stronger in iron ore and in thermal coal, bouncing around between these support resistance zones over here, and we've seen a little bit of a strength in Whitehaven. We've certainly seen strength in Rio based on the previous chart. We've seen Rio and Fortescue get to all-time highs on the back of the iron ore price. Right, that's what I'm going to cover today. I'll just go back to SPX and we will have a look at some questions. Colin has asked, hello, Gary, you haven't seen any trader analysis. You haven't seen any trader analysis for a long while. Are you planning to start again soon? Thanks, Colin. Trader analysis, that's SPA3 Trader. I'm assuming that you are referring to there. Certainly, we might do that in one-off connect and grows. I won't do it in the market update session, but we can certainly look at that if people want to look at the trader analysis. Very pleased you do these sessions, Gary. This is from Brian. Always good to step out of the picture and have a look. Certainly helps me to navigate my macro investment decisions. Thank you for that, Brian. Right, if there's no other questions, we'll end it there. The summary of the session is that we've got pullbacks, retracements, and these are pretty normal. They're pretty shallow at this stage, given the run-ups that we've had. And I'm really looking at this S&P 500 chart here. So just to put a picture to the words I've just said, strong run-up, no retracement. That's hardly even a retracement in the middle here. Now having expected retracements. What we don't know is whether these are going to become steeper and deeper, or whether they're going to find support pretty soon here and end up remaining shallow. And then seeing the breakouts to above previous peaks on all the indices. And with three of the indices, the NASDAQ100, the DAX, and the Dow Jones, they are already above their all-time highs. Sorry, the NASDAQ100 hasn't. It's fallen back into the range again, but at least to find support above their previous lows and to break out above their previous highs in the next couple of weeks. So I'll be back in 2 weeks' time to follow this exciting journey, the next saga in this exciting journey where these markets are right at these inflection points. And if they do break above, then we're going to see strong bull markets. If they don't, then we are going to see quite a bit of volatility going into February. So until then, thank you for your time and attendance. Some questions, just coming over here. A couple of thanks, 3123 thanks. Rob's asked, are these charts available to users who only have ASX? Yes, there are, because I used world indices charts for the indices, which means that you will be able to see these indices when we upload the analysis. So you'll be able to just download. I'll show you how to do that quickly. If you go to just right click, go side panels, and you go into analyses manager, and you go top right hand corner here, and you go on this one, which is import SDS analyses, and it'll pull in these analyses and it'll put them all the way down the bottom over here, and you'll be able to look at these analyses that I do look at. So I'll finish on that. Thanks for your time and attendance. Happy New Year again to everybody. We'll be back in a week and a half to do another one of these. Until then, I wish you consistent and objective and peaceful investing.